Hello and welcome to Donut Investment. This analysis is for the stagflation reaction function as of 10th of July 2026. The full report is on donutien.ca. A steeper curve, a bid under gold and real assets, a structurally softer dollar, and equities that must earn their multiple. Let's start with the backdrop. Stagflation is a rare, nasty mix. Prices keep rising too fast, while the economy slows and unemployment climbs. It's the hardest spot for the Federal Reserve, because its two jobs clash. High prices say raise interest rates, rising unemployment says cut them. In stagflation, both are true at once. Our house view makes this the single most likely path, at 38%, though far from certain. It's the one regime that forces the people in charge to choose. So who decides? Two people. Kevin Warsh runs the Federal Reserve, which sets interest rates. Scott Bessent runs the Treasury, which manages the government's huge borrowing. Here's the thread most coverage misses. Both are protégés of the same man, Stanley Druckenmiller, one of the most famous hedge fund investors alive. Bessent made his fortune working under him. Warsh has been his business partner for 15 years. So they think alike. But in stagflation, they want different things. Warsh wants to hold rates high to defend the Fed's credibility on inflation. Bessent wants cheap borrowing, so he leans toward looser, easier money. It comes down to one decision. When growth weakens, does the Fed hold firm, accept a recession to crush inflation, as Paul Volcker did in the 80s, or blink and cut rates to protect jobs and cheapen the government's debt? Our read is that it blinks, sooner than Warsh's tough talk suggests. He wanted cuts before inflation spiked. The debt bill is huge, and he's built a way to justify easing using his own softer inflation measures. That's a judgment, not a fact. And if he holds the line, much of this is wrong. So if the Fed bends, what happens to your money? Start with the broad asset classes. Long-term government bonds are the clear loser. Heavy borrowing plus sticky inflation pushes long rates up, what traders call a steeper curve. Cash pays you to wait. The dollar holds up for now, then weakens over time. Gold and real assets, things you can't print, are the core winners because they hold value as money is made cheaper. In commodities, gold and silver lead. Copper is a slower burn winner as industry retools, and oil stays firm near term but is capped later. Now the stock market, sector by sector. The winners are the real economy and defensive names, energy and materials, which inflation and hard assets favor, consumer staples and healthcare, which people buy whatever happens, and banks, which gain from that steeper curve and lighter regulation. The losers are the rate-sensitive and expensive names, pricey technology, marked down when long rates rise, consumer discretionary, as squeezed households cut back, and property trusts and utilities, which trade like bonds. In one line, own steady, cash-generative businesses with pricing power over expensive growth. Now the other side, loudly, because none of this is certain. Stagflation light is our best single guess at 38%, which leaves a 62% chance it's something else. If the economy simply re-accelerates, about a 1 in 4 chance, the Fed stays tough and gold and bonds get hurt instead. If growth collapses into a bust, the map flips toward owning those same long-term bonds, and if Warsh proves a true inflation hawk who won't blink, the easing never comes. This is a map of what's likely if one scenario holds, not a prediction and not financial advice. So our call on the stagflation reaction function, position for a Fed that bends to a loose Treasury if stagflation holds. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donutien Investment at donutien.ca. The link to the full report is in the notes below. Have a great day.